Hey guys, Ron Parks here and welcome back to the channel. You've all heard of Bitcoin and cryptocurrencies, which have been in the news recently, a lot in the news. You might think it's complicated and too much to handle, but I will filter it down to a story that will explain it all. Let's say there's a coin that is worth $60,000 today. The coin is not made of gold or platinum or some other precious metal. You cannot see it, you cannot feel it, and it doesn't exist physically. It exists digitally in computer code. Bitcoin is not like a regular piece of currency which a government or central bank controls. It exists in a blockchain, which is like an accounting ledger. All transactions exist in the blockchain ledger. The government or a financial entity does not control this. It is all decentralized, and there are thousands and thousands of people all over the world keeping this blockchain reconciled and accurate. Think of it this way. You're at a casino in Las Vegas and are playing poker. The casino has no chips and you cannot buy chips. You have 5 players around the table, all betting on hands from the dealer. So how does anyone know who is up and who is down in the game? Well, every player has a piece of paper that records at the end of every game who won and who lost and the amount of money won or lost in each hand by each player. At the end of the game, you can compare all of the ledgers, and if there is an error in one of them, it can be corrected since many people are tracking the outcome. It's not held by one person or one institution. It is decentralized. That is how a blockchain works. If you picture this piece of paper with all the hands played, you might have pages and pages of information. Think of these pages as a block of transactions, and if you add all of the pieces of paper together, you have a chain. So that is what is a blockchain. Now you might ask, how are all of these thousands and thousands of Bitcoin blockchains? Well, how are these ledgers kept in sync? Let's think about our poker example again. You can think of the entire Bitcoin peer-to-peer network as a vast poker table with millions of people playing. Some are exchanging money, but many are volunteering and are keeping the ledgers, and I'll talk about that later. If you want to exchange money, you need to announce it so the people keeping track can record it on the ledger. When you announce a transaction, you're also announcing your account number, the account number of the person you're sending the Bitcoins to, and how many coins you're sending. All of the people that are keeping copies of the blockchain will add your transaction to the ledger. And having lots of people keep track of the blockchain sounds like a great security system. But if you only need a few account numbers to send Bitcoins, well, that seems like a big risk. Think of hackers that get into your bank account or credit cards and make unauthorized transactions. There's a centralized body that keeps track of your transactions with regular financial transactions, like a credit card company or bank. They might monitor transactions for unusual activity or call you if there is a significant withdrawal from your account. But with Bitcoin, everything is decentralized. Now comes cryptography, which is a mechanism that keeps Bitcoin and other transactions safe. Cryptography is the science of secret writing. It's an ancient art. The first documented use of cryptography in writing dates back to 1900 BC, when an Egyptian scribe used non-standard hieroglyphics in an inscription. There are 5 functions of cryptography. Number 1, privacy and confidentiality, ensuring that no one can read the message except the intended receiver. Number 2, authentication. That's the process of proving one's identity. Number 3, integrity, assuring the receiver that the received message has not been altered in any way from the original. Number 4 is non-repudiation, which is a mechanism to prove that the sender actually sent the message. And number 5 is key exchange, the method by which crypto keys are shared between sender and receiver. There needs to be authentication to verify a transaction aside from the 2 account numbers in the trade. Bitcoin is secure because of keys that are pieces of information that can be made to make mathematical guarantees about the message. Like this is from Ron Parks. After you create an account on the Bitcoin network called a wallet, you get 2 separate and distinct keys, a private key and a public key. The private key can be verified, known as signing it, so users can verify it later on if they want to. So it is pretty simple. When I want to send some Bitcoins to someone, you sign that message using your private key. You are the only one who has it. The message goes out to the Bitcoin network, and everyone that is verifying the transaction can use my public key to confirm that my signature is valid. And then everyone who is keeping track of all the Bitcoin trading can add that transaction to the blockchain. If the public key works, then, well, that's proof that my private key's message was signed and validates that I actually sent the transaction. This proof of identity is not something that a scammer can generate. Now let us look at the who part of the transaction. The who part of the transaction matters to verify that the correct people are trading the Bitcoins. But the when part is also essential. Think about it this way. If you have $5,000 in your bank account and try to buy two things for $5,000, each bank will pay for one and deny you the other. This is a way to prevent you from spending the same money multiple times. So as with Bitcoin, there's a check to make sure that you can only spend the coins that you have. The Bitcoin network and your wallet will check your previous transactions and check that you have enough Bitcoins to make the transaction. There could be a problem with the timing here, since many people are keeping copies of the blockchain. Network delays could mean, well, that you will not always receive the transaction requests in the same order. You now have many people with different blocks to pick from, and none of them are necessarily wrong. Bitcoin solves this problem by using math. To add a block to the chain, each person needs to solve a math problem created by a cryptographic hash function. Well, a hash function, in simple terms, is a function that takes a set of inputs of any arbitrary size and fits them into a table or other data structure that contains fixed elements, 0, 1, 2, 0, 1, 2. The table or data structure generated is usually called a hash table. Bitcoin uses the SHA-256 logarithm to hash data into a 256-bit number. This means you can put any data into the logarithm and it will spit out a 256-bit number that uniquely identifies that data. And if you put your name through the logarithm, you can receive your SHA-256 hash ID. However, if you change anything about your name, like the spelling or capitalization, and hash it again, you'll get a completely different number, unrelated to the other hash. You cannot use the SHA-256 hash to work backward and figure out the data behind it, but you can always take the same piece of data and get the same hash, 256-bit number. This is the entire concept behind a blockchain. Take two blockchains, A and B. First, A is added to the network. The miners collect transactions into block A and hash all of that data to generate a 256-bit number that uniquely identifies block A. Call it hash A. Then miners work to create block B to add on top of block A. Miners collect another set of transactions that add hash A to block B. Miners then hash the new set of transactions plus hash A to get hash B. Now, if a malicious actor were to go back to block A's transactions and change even the smallest detail, then hash A would completely change, which in turn would change the subsequent hash B because you just altered the data that block B hashed. And since it requires a lot of computing resources to create a block and add it to the network, it would require even more work to alter a previous block. Say block A, add that to the network, and then recreate block B with your new hash A, and add that to the network, all before the rest of the mining network has moved on to block C, D, E, and beyond. You can't just add any hash to a block and add it to the network. So in order to be the miner to add the next block, you have to win a competition to find a correct hash. And that solves a complex math problem. Since there is no way to start with a resulting hash and work yourself backwards to figure out what piece of data gave that hash, the Bitcoin protocol uses a feature to create its complex math problem. The math problem stipulates that the first miner to produce a hash with a certain amount of leading O's will be the winner of that block and will be able to add it to the network. Remember, a hash is just a 256-bit string of numbers and letters. It's a hexadecimal number. Complicated? Yes. Specialized computers are known as mining rigs, and they perform the equations required to verify and record a new transaction. Volunteers spend tens of thousands of dollars, hundreds of thousands, on computing power to solve the math problem and win the ability to add the block to the chain. You might ask yourself, well, why do they do this? Well, the incentive for dedicating computing resources to the network and continuously expending energy to verify transactions is the block reward, which now is 6.25 Bitcoins, generated out of thin air and paid to the person who won the math problem. You might have heard of these people referred to as miners. Well, miners work to mine new Bitcoins to add them to their account by winning this math problem. Think of a miner with a pickaxe swinging to find the gold. Also, miners who win to add to the block also are given a small tip. After every 210,000 blocks, the number of new coins generated when a new block is generated goes down by half. So what started as a reward of 50 Bitcoins went down to 25 and then 12.5, and now it is 6.25. Eventually there'll be so many transactions on a block that it will still be worthwhile to mine and get the tips. The current projection is that the last Bitcoin mined, as it's set to a maximum of 21 million, will be mined in the year 2140. This decrease in coins is modeled off the rate that gold is dug out of the earth. The idea is that keeping Bitcoins limited will raise their value over time. On the downside of all of this, there is so much electricity used by all of the miners trying to win Bitcoins that it is considered very ecologically unfriendly. In 2009, Bitcoins did not have much of a perceived value, but now, as of March 2021, one Bitcoin is worth $56,800. So you can see the frenzy to win that math problem and have the most computing power, as 6.25 Bitcoins are worth $355,000. That's a lot of money, but the competition is fierce to win those coins. So let's summarize all of this. Unlike services like Venmo and PayPal, which rely on the traditional financial system for permission to transfer money and on existing debit or credit accounts, Bitcoin is decentralized. So any two people anywhere in the world can set Bitcoin to each other without the involvement of a bank, government, or other institution. Every transaction involving Bitcoin is tracked on the blockchain, which is similar to a bank's ledger or log of customers' funds going in and out of the bank. In simple terms, it's a record of every transaction ever made using Bitcoin. Unlike a bank's ledger, the Bitcoin blockchain is distributed across the entire network. No company, country, or third party controls it, and anyone can become part of the network. You just need to download the software. There is a world of Bitcoin miners solving challenging math problems with lots of computing power to verify every transaction and add a new block to the chain. The winner adding the block gets paid with those Bitcoins. And there will only ever be 21 million Bitcoins generated. This is digital money that cannot be inflated or manipulated in any way. It isn't necessary to buy an entire Bitcoin. You can buy just a fraction of one if that's all you want or all you need. So that's how Bitcoin operates in a nutshell. A little story I told. And if you follow the storyline, you can see that there are a few steps that need to be taken, but those steps are clouded in very complicated mathematical calculations. And you might ask, what do I consider Bitcoin or other cryptocurrencies to be? Well, I consider them an investment and an alternative to holding gold or some precious metal in your portfolio. Susie Orman recently said on CNBC that she doesn't see Bitcoin as an alternative to fiat currency. She goes, I do not like Bitcoin as a currency. I wouldn't say I like it where you're going to buy a Tesla or something with it. I'd like it as a possible replacement for gold as an investment. If you're a gambler and a risk taker, then by all means have fun. But always stick by sound investing advice. Never play with more than you're willing to lose. And be sure to do your research. So I hope you enjoyed this explanation of Bitcoin. If you have any comments or questions, please leave it below. I'd be happy to answer them for you. And if you really liked the video, please smash the like button and subscribe. I post twice a week and sometimes more. So thanks again for watching, and I'll see you next time.